Oh my gosh, we're doing another video. We put one out yesterday. We're doing another one today because the market is completely changing. I'm Trent, and this is Mark, the technical genius.
No, no, no.
We're the two regular guys. This is welcome to the two regular guys show. We're a part of the best of U.S. investors. And today we're going to get into mega cap earnings, the Federal Reserve and their decisions, along with what's going to potentially happen for the rest of the week, along with the risk off, risk on trade that we have seen for many years and the rotation that we're seeing, and bonds. Yes, boring bonds. So let's get the show rolling.
Okay. So I was wondering, I can see right there how small we are, us two regular guys, right
Oh,
behind
yeah.
you. Yeah,
Yes.
I thought we were bigger than that, but I guess we're just really, really
We're just two regular
small.
guys right
We are
there.
just two, yeah, we are just two regular guys. So when we talk, we're just talking about our opinions. This is not financial advice or anything. Uh, but we see the economy the way you see the economy. We live in it. So, okay. We don't live in the east or west coast big cities where people are seem to be immune to what's going on in the real world, and that's what we look at. And Trent and I both have a background in financial services business, so we have a little bit of a knowledge and background of seeing how this system works and how it doesn't fight for you, it fights against you and tries to take your money away. And I think what we're seeing, yeah, this week is a good indicator that they're trying to take your money away. Okay. Uh,
Yeah.
Again, these are just my opinion and Trent's opinion, but let's go forward and see what's going on. So what's going on? Well, we have earnings. Okay, mega cap earnings,
Big
and they
week.
kicked off. They kicked off last week with Tesla. Okay, and Tesla earnings per share were 52 cents versus 61 cents expected, 91 cents a year ago. Okay, so you're seeing that Tesla is not providing the EPS that they want. Sales 25.5 billion versus 24.5 billion expected, so a little bit up. Operating profit margin 6.3% versus 8% expected. Free cash flow is 1.3 billion. They expected 1.9 billion. So as you know, what happened to the market last week when Tesla came out, and then Google came out, and their earnings were solid. Okay, they were good. Uh, they were in line with the analyst estimates on revenues and earnings, but they missed in YouTube advertising revenue, and their forward guidance wasn't all that rosy. And we said earlier in the week, if we need to see these guys hit it out of the ballpark in their revenue earnings and in their guidance, and we're seeing a few chinks in the armor. And then we saw Microsoft came out, and their cloud computing revenue slowed in the latest quarter and is expected to slow further in the current quarter. So that hit Microsoft. I mean, everything came back yesterday, and we'll talk about that. And then shares of Meta. Okay, the company reported better than expected set of core earnings, and they offered a better, rosier future in the future. So you saw what happened to Meta. So the big cap earnings are not as spectacular, in my opinion, as the market was looking for. Would you agree, Trent?
Oh yeah, I think we've all gotten used to this whole like all these companies are going to nail it. They're going to hit it out of the park. They're going to surprise earnings on the upside. And what's happening is they're not. They're meeting expectations or they're coming in below expectations. And the market is starting to finally look at it's converging with the economy that you and I and everybody watching this lives in.
Right, right. And I would say that when I'm looking at these earnings, a lot of the analysts are looking at how much are these companies spending on AI stuff. Okay. And they're like, wow, look at all the money they're spending on AI stuff. And I ask myself the question, well, if I go out and I invest, let's say uh, here on the farm, I go and I invest, $1 million into a new cattle operation, and I have to go spend that money. I expect a return pretty quickly because I have to pay that money back. And when are they going to start showing the returns? I think is the big question that I would be asking these big companies. Spending's easy when you have the money. It's the returns you're going to try to find.
Yeah, and I think I did a video earlier this week on a Goldman Sachs memo that went out about how Goldman Sachs looks at this $1 trillion spend on AI, and what they're looking at is when are we going to get a payback on this? When is our return on investment going to happen? And they don't believe it's going to happen anytime soon. Similar scenario to when Jeff Bezos went from offering only books as Amazon.com to web services. They went out, they spent a lot of money getting the systems, the data centers, all that. And Wall Street came back and said, Jeff, when are we going to get our money back? When are we going to get a return on this investment? And the answer was not for a while. And that's when I think publicly Goldman Sachs or some others said, Jeff, go back to selling books. Now it's paid off for Amazon, but it took a long time to recoup that expense and start making money on
I'm AI to me, and just recently, and I don't mean to be political or anything, but just this week, they punched in AI talking about the attempted assassination of Donald Trump, and it didn't come up. It came up Truman, it came up Kennedy, Meta. When they typed in and they showed that picture, they said that was fake news when the picture of Trump there with this, with the flag behind him and the secrets, they said it was fake news. So myself, until I start seeing AI actually jive with what I know as fact,
yeah,
I'm not a big AI person, okay, because I don't know what or who is programming this information in. To now I'm at the point, when I get this information back, is it correct or is someone swaying it one way or another? And until they prove that to me, I'm not so sure that AI is great in that respect as far as being able to go and get an answer that I want it to be. Okay, so if you start getting doubt in your consumers, how's that going to affect AI?
Well, and I think that the other element of this is the adoption rate. The media would have you assume that AI adoption was going to happen instantaneously. I know people who don't own a cell phone. They don't own a laptop. They have a desktop and they have a dial-up internet. It took a long time for the internet adoption to happen. My first introduction to the internet was in 86, and it was DOS. It was a friend of mine who would, instead of faxing letters, they would get online through DOS and they would talk back and forth through a dial-up. That adoption took a long time, and I think this is no different, especially with debacles like you saw with Google and Bard, when people went in and typed in, give me an image of a XYZ person,
yeah,
and it wouldn't return what that person really looks like.
right.
I think you're right. It is, you have to look at this technology as we're in the very, very beginning of a first inning of this 9 inning ball game when it comes to this. And so my generation is slowly adopting it. Carrie's generation, no, they're not going to adopt this. They're so skeptical of it anyways. It's the adoption from my kids' standpoint, and the kids behind my kids who are in their 20s. That's when that will become big, but it's going to take a while. And I think this is where AI is going to start running up against a wall.
Yeah, and I go back because I can remember the .com era and everything was .com, that didn't even do anything with .com, but there was a fever of everybody to get in fear of missing out on the .com, and I see the same kind of thing here, and again, AI's there, it's existed, but it's early, and it hasn't been proven to me just by the things I've seen that it's correct in what it provides back to me. Okay.
Yeah.
So
I think
I may be an outlier, but
I don't think you are, Mark. I think as earnings continue to roll out and we're going to see beating earnings or lackluster earnings in these companies that we've put a lot of focus on, the reality of this is going to come to the surface. So in relation to what we have seen with the MAG7, Meta was positive, but I always go back to ad spend and the consumer. That is the consumer consuming, that would justify a company advertising more on Meta, more on YouTube and Google. Those are, and I look at the consumer, and the consumer is just, they're in pain. They're struggling.
Absolutely. I mean, we've talked about the credit card delinquencies. We've talked about uh, cars being repossessed, and people just living paycheck to paycheck. And let's just, talk about the Fed a little bit, because they have a different view of the economy, I think, than you and I have, because this week they had the Federal Open Market Committee, came out, and we watched yesterday. We had it on the Platinum Live where, Powell was talking. And so, yesterday, they held the interest rate steady, but they opened the door, they said, to reducing borrowing costs as soon as its next meeting in September, as inflation continued coming in line with the U.S. central bank's 2% target. Okay, we've heard this story before. Okay, and I almost feel like the big bad wolf, the big bad wolf in Goldilocks. And anyway, so inflation. This is, I took a couple. I went and I looked at their statement, and I have to disagree with some. Inflation, the Fed said, was just now somewhat elevated. Okay, so let me a key downgrade from the assessment that is used throughout much of its battle against rising prices, that it was elevated. So now it's somewhat elevated. So I ask everyone who's a common guy or gal, did you go to the grocery store or go to the gas station and say, oh, my gas is only so much elevated? Did it go down to where it was before, 3 or 4 years ago? Not in my state. How about with you? I mean, I find that deceptive to me.
And you and I talked about this earlier today, and that is, there's always an agenda. No matter what there is, there's an agenda. And this the Fed funds rate has become a political agenda. It's about trying to ward off potential disaster. I mean, if the Fed really measured inflation as you and I and everybody watching this measures inflation, it would be nowhere near 2%. It would be in the double digits, in my opinion.
Well, yeah, and they're talking about the rate of inflation increasing month over month or year over year. That's what they're saying is, but they call it inflation's coming down, but it's just the rate of the increase is coming down. And that's according to their reports, which we know, we talked about, excludes this, excludes fuel, excludes everything that we need to live on, and then it's like, oh, it's great. And when I have a high paying government job or a high paying financial business channel job and making millions, inflation doesn't hurt you, like that. It hurts us. Okay.
Right.
So you get a bill like I did with house insurance doubling here, and that puts a sting in because your income doesn't double,
Right. Right.
So,
I mean, McDonald's came out with earnings this week. Their costs are going through the roof. So they have to raise the prices on their menu, which then their market, who they sell to, can't afford it. So they're not showing up at McDonald's to buy anymore. They're not spending like they were spending. And so that's affecting, in my opinion, the lowest denominator of it's the lowest it's the biggest, one of the bigger demographics in our country, but it's at the lower end of the income scale. And when those people don't have money and they can't feed their families, big bad things happen.
well, and you don't see anyone on CNBC or the Fed getting too skinny because they're missing some meals.
No.
They're just not. They don't live in the same economy that a couple regular guys like us and everyone else lives in. They went on to say, the Fed, so far the economy has continued to expand at a solid pace. Okay, so the GDP came out as 2.2 or 3%. And when you dug into it, it was because of government spending, because we see what's happening. We're every Tuesday and Thursday, we go and see how many treasury bills come up, okay, or bonds. And they never sell out as far as I know. Now I've bought some CDs before where I put in the order and says, oh, we're sold out. They only do so many. I don't see that in the federal government. So they will take as much of your money and give you back 5.4%, on a month-to-month T-bill as you're willing to spend to keep this government going. And then they went on to say, its statement, and while job gains have moderated, I like the way they wordsmith those, moderated, the unemployment rate remains low. Okay, so I think it just went up to 4.1%. Okay, so that may be low, but when you dig into those reports, who's getting a job? Part-timers. Okay, so and they count you and I get 3 part-time jobs. That's 6 jobs. Okay, even
Yeah.
though they're part-time. So again, manipulation of the reports. We saw this week ADP came out. ADP does private employment. On Wednesday, and they showed private payrolls rose by 122,000 jobs in July, way lower than consensus figure of 150,000. In addition, the U.S. July Chicago PMI fell to 45.3, a smaller decline than expectations of 44.8. And finally, U.S. pending home sales rose 4.8% in May, month over month in June, stronger than expectations. So we're seeing a little bit of the home sales come up because we're seeing some of the mortgages come down, but the mortgages are still at 6.78%. And a year ago, I think they were at 6.9. So they're still relatively high. And when you look at, they talk about jobless. The jobless claims came out this morning. Number of people claim unemployment benefits from the U.S. rose by 14,000 to just under $250,000. Okay, or 250,000 people. And when you start getting into these numbers, you're starting to see more unemployment. And we go over the companies that are laying off. Okay, we
Yeah.
see it.
Yeah. And some of the it's major layoffs over the last 6 to 12 months in the tech industry.
Yep.
Is that because they're getting replaced with AI? No, it's because the revenues are declining. Their margins are getting squeezed. So it's a continuation of that. I guess then it comes to the question of what is there's a lot of hype around the Federal Reserve and lowering rates. Mark, what does that mean to you and I when it comes to that? What is lowering a Fed funds rate really what mean?
You know what it means to me? Piddly squat. It means piddly squat because, okay, they lower a quarter basis point. Now we're at 5%. And all that is, the Fed funds rate is what they lend each other in banks. Okay. It has nothing to do with my mortgage. The 10-year has something to do with my mortgage. Okay.
Mm-hmm.
They might follow closely the 2-year yield. If you look at the two charts of the Fed fund rate, the 2-year, they follow that. The 2-year's down, so they'll probably try to follow that down. But it means crap to me. So let's say, everyone's all excited, and let's say that yesterday they lowered the rate by a quarter point, and the market just skyrocketed. For what? The market's been going up anyway for 18 months. Okay,
Right.
And the rates have been there. So what is that actually going to do? If the economy is so good and so hot, okay, why do we even need the lower rates at all? Why wouldn't we be raising the rates to kind of keep it from powering ahead too much?
Right.
That's my view. What do you think?
I agree. I think it's a misunderstanding of how the Fed funds rate relates to you and I as two regular guys. And it's that important to understand is that relationship to if I'm a prime dealer bank and I go borrow money from the Federal Reserve, right now I'm borrowing at 5.33%. If they lower a quarter point or 100 basis points, and let's just say it gets to 4.5%, they're borrowing at 4.5%. And then the question is, are they going to lower their margins when they lend it to you and I? And because this is especially publicly traded banks, this is about making money. My belief is they won't. So you and I won't necessarily see that money become cheaper to us. It's just going to pad their pockets. Now, as you pointed out, a mortgage rate, 30-year, mortgage rates are based on the 10-year U.S. Treasury. And today they went below 4%, which is pretty substantial. We haven't seen that for a long time, since the beginning of the year. And they're at 3.98%. That does translate over to you and I when it comes to if we got a mortgage. The question is, are they going to be as willing to give you if they add on, say, 3% onto the 10-year U.S. Treasury, and let's say U.S. Treasury's at right now at 3.98, that means your mortgage is at 30-year mortgage is at 6.98 theoretically. The question is
credit score, depending on your
credit score, your revenue,
your
debt,
job status,
because these banks are now being audited by the Fed, and they're having their books audited and their loans audited. And as a friend of mine who does commercial lending said, they're coming in and they're downgrading a lot of these commercial loans from standard to substandard. And about 40% of these banks are 40% of the banks' loans are being downgraded to substandard, which means they're not confident that these people are going to pay it back. So if they do lower rates, is this, and it drives the 10-year down, does this actually help commercial loans that are coming due to refinance at a lower rate and prevent a mass collapse of commercial loans and banks who lent them that money? I sort of think that could be in the game right now because of the risk of the amount of commercial loans that are coming due and have to be refinanced at astronomical rates versus what they had.
We've talked to our members in the Zoom call on Friday who are business owners, and they said, well, yeah, banks will take your loan application. They're just not going to lend you the money. They'll go through all the, and he says, we're just not seeing the money flow anymore, even though they'll go through the process. So that's the other part of it. So what? If you can't get the loan even at a lower rate, what's the point?
Right. Yeah, I think, and that's the thing I'm looking at is if the 10-year treasury goes to say 3.75 or 3.5, that could be a short-term relief valve for some of these commercial loans that could be in trouble because of the high interest rates they're having to refinance at. Maybe that is part of this game that's being played right now. Whereas if you didn't see a drop in those interest rates, you could see a lot of commercial banks go under in a heart. I mean, commercial loans go under, which then would drag down the banks as well. So,
well, and
I don't know.
Even in residential, if people start losing their jobs and can't afford their mortgages, you're going to see a lot of houses come up more on the market.
Yeah.
And because people can't pay their mortgages anymore. We're already seeing they're having trouble with credit cards and they're having trouble with car payments.
Yeah.
Here's
go ahead.
I said we could be back into the 2008 scenario here, in the housing market because people can't afford their mortgages. You go and look at cost of insurance, cost of property taxes, things you have to pay. Okay. You might have something that breaks in your house and you don't have to fix it. Okay. Right away. You can let it go. Your deck has a board out or whatever. You don't have to fix it, because you don't have the money, but you have to pay your property taxes and you have to pay your insurance and you have to pay your mortgage. So if those things go up, you're going to see people, especially if their salary doesn't go up or they lose their job, you're going to see that hit the market. That'll be the third leg of the stool that breaks, in my opinion.
I live in a tourist area, and a lot of the homes that have been bought in the last 5 years are secondary homes, and a lot of them are Airbnb homes. And we have seen in my area, and I suspect a lot of Florida is seeing this, is a lot of these homes are going up on the market, and we're starting to see more and more reduction in the prices because they're not being bought. And could there be this Airbnb collapse that could hit the vacation market, which would be Florida and some of the other coastal areas, along with even the mountain towns, in the Rockies and where, the ski season. I track home prices in Crestview, Colorado. In this month alone, I have seen more reductions in prices and more homes and condos for sale. And they're getting back down to levels where you go, oh, that's interesting. That's not astronomical like it was. And I think you're starting to see that secondary home market, Airbnb market, starting to really feel the pain because we're not going on vacation like we did.
Right, people aren't staying, so they're making 2 mortgages now, payments, and who probably at a higher interest rate than what they could have got 5 years ago.
Yeah, exactly. I look at this. Go ahead.
No, I was going to say, even I was just down in Florida, and I always watch Florida because I wouldn't mind. picking up property in Florida at some point when it all falls apart. But you're seeing condos are in trouble down there, and you probably know more than me because they did this revaluation after that one condo sank into the sand and got destroyed. They're going back and they're looking and reassessing the maintenance and all these companies. They're like, all these condos, they're saying, well, we got to upgrade this or that or structure. And so whoever's in those condos, if it's a 15 unit condo or a 100 unit condo, they're getting this bill, and it's a 6-figure bill to pay.
Yeah.
And they're like, we can't afford this.
Yeah.
And so the condo market's in trouble down there, from what I understand. Is that right?
I would say you're seeing more. My area, the condos are newer versus, say, Southern Florida, where they're older condos. I would say my area is feeling the effects. We're going to see more HOA due increases because of the cost to maintain these places, and we're getting into that age range where maintenance is starting to be needed, and now the cost of maintenance is going up. And I think you're going to see more and more people say, I can't afford this. And they throw their houses on they throw their second homes on the market, condo market. Worst case scenario, they get an envelope and they mail in their keys and say it's yours. And that really is a big risk for these banks.
Yeah.
Is they get a bunch of jingle mail, So I love that.
Yeah.
Jingle mail. What's that?
That's
It's
not
the
Christmas
keys to
time,
the
I can tell you that.
Yeah, it's not Christmas. But here's the flip side of this, Mark. And you and the tribe have been pounding the table. You in particular have been pounding the table about buying U.S. Treasuries and U.S. notes, T notes. And if you had bought, the 10-year Treasury back on April, say end of April, you would have probably gotten a yield of right around 4.74% on the 10-year. Okay. And a lot of people, I don't think, really understand the mechanics of a bond. So in that yields up here. Yeah, yields up here. Trying to do it in reverse. And
it's a teeter-totter.
Yeah, it's a teeter-totter. And the value of that bond's down here. Well, now the 10-year Treasury is at 3.98%, which means the value of that bond is going up. So as you're risk managing your portfolio or you're looking for a trade, this is one of those areas where as we get into this risk-off environment more deeper and deeper, you're going to see more money flow into risk-off assets like gold, like bonds, real estate, that becomes reasonable. I would say there'll most likely be an incredible opportunity to buy real estate, and other sort of hard assets that go up in value as risk off. And I remember people just bonds are boring, but if you've ever met a bond trader who's very successful, they make a ton of money at trading this yield.
The bond market is 6 times larger than the equity market. It's the largest market ever. And what is the 30-year going for right now? 30-year Treasury. Do you have that up?
Give me 1 second here.
Okay, because 30-year Treasury is linked with the TLT, and we're going to look at a chart. And we've talked about the TLT, that when the market rolls over, the TLT traditionally has done very well. It did well in the 2008 financial crisis. And we're starting to see that a little bit now, and I'll show you a chart here in a minute.
I'll share my screen here for you.
Okay.
Let me know when you can see this. So right now,
there it is. There it is. Yeah, is this a 30-year?
This is 30-year. It's at 4.27%.
Okay.
Back in April, it closed at 4.78%, so pretty significant drop. And then
go ahead.
And if you go back to October of 23 and rode this train, you bought it at 5%, it got as low as 3.95%. That is, you think about this. A company like a hedge fund like Citadel they're out of Miami now. They used to be out of Chicago. They're a major $36 billion plus hedge fund. They're a market maker. They take a trade like this and they say, okay, what's the standard deviation? What is the risk potential of a 30-year U.S. Treasury? And they say, okay, it's up here right around, I can buy it right around 5%. I see where the economy is going. I can then take $1 billion, borrow, margin up, say another 3 or 4 billion. And then if you go back and look at some of the historical events like long-term capital management, who leveraged up 50 times
Not
and how
recommended.
and not recommended, and that
Yeah.
did not work out well for those guys or those banks. But this trade ends up yielding an enormous gain because of that teeter-totter effect of
Yeah.
bonds. And if you look at where we are at today, when I look at the 30-year and I go, okay, are we at a support level? And if is this support level going to hold, and are we going to see a move back up in yield, so a flood out of bonds, or are we going to continue to see a flood into bonds? And are we going to see 30-year treasuries, you know,
we do talk a lot uh, on the bottom swing trading side of the channel about bonds because it's such a important part, treasury bills mostly,
yeah,
important part of your money and keeping your money working for you. So every Tuesday and Thursday, we look at what the current yield is on these bonds. And you showed back on the bonds, 4 point whatever 7%. I went in, I forget when it was a while back when the 30-year, you can buy the 30-year. I forget how often it comes up, but it's on Thursdays. And I bought a 30-year treasury bond.
uh-huh,
It was at 4.6%. Okay. And now, what's it at? 4.3 or something?
uh, 4 4.26.
Yeah. Because that yield went down, my bond became more valuable because it's 30 years. Okay. So I can take that bond on the secondary market and sell it for more than par, which is what I paid. And someone was willing to buy that because there's still 29 and a half years left on that 4.5% right now. And so you'll see in your account, it's just like a stock. And it's so weird because my yield has gone down, but my price has gone up. The
Yeah,
demand is there because what they're buying is your yield. And you locked in at 4.5, where, in the case you showed 5%. And people are like, that's pretty good. How much, there's a formula, how much time is left on that bond. And, they
yeah,
figure out the price, but you can see that happen. So I actually have, some 30-year treasuries sitting in there at 4.6 something percent because I bought it. And then we had some fluctuations, and you could see when it went above that on yield that my value was below par, but
yeah.
now it's up. But you can do that even easier on the TLT if you want to do that. Okay. And I have
Yeah.
a chart here,
Okay.
and we'll just show it. We'll just show if I can show this chart. Let me see here.
Should be able to.
Okay. There we go. So this is interesting in what's happening today. And today is August 1st. Okay. And the Fed meeting was yesterday. This yellow line is the Russell 2000. Okay, and you can see where we had a rotation from. This is the SPY, the weighted SPY, which has the top 10 stocks in the SPY. This weighted are 37% of the market cap. This is the equal weight. You can see that there was a rotation into the small caps, and then we've kind of been zigging. Okay, and then you see rotation out of uh, the SPY, and even in the equal weight SPY, you're seeing today everything's down. You got the Russell 2000 small caps down. You got the weighted SPY down, and you got the equal weight SPY down. But what's up? This here is the TLT. You can see where money's moving. It's
Yeah.
you always call it flight to safety, and you can see the money's moving in to the longer term bonds. And the reason why is we're starting to see those yields come down and the prices are coming up. So you can use charts like this to kind of see where money flows. That's where
Right.
I look at it. And you can see if it's a rotation or it's just a regular sellout.
Yeah. And the move in the TLT in the last week has been very significant, in my opinion. Um, and we've talked about that rotation trade for a long time. We've actually been called out by a couple of people saying, when is it going to happen? It's never going to happen. Well, it always happens. It's just a matter of time. You look
Look at
at
the gaps.
TLT.
This is gaps on TLT. Okay,
This is a
bonds.
bond in
Yeah, on a daily. Let's just look at a weekly, just to be fair and kind of look back a little. So here's your weekly. You can see the weekly is a little different.
Yeah.
Um, that we're just above the 9. We're playing above the 9 here a little bit along the upper Bollinger Band. But, even on the weekly, we're starting to see the TLT take off just a little bit here.
And you look at this, and if you look at it from like a swing trading point of view with more of a longer duration, this to me, and you're the expert at this, I'm looking at this going, this is a bunch of base building, foundation building in this, knowing that something was coming in the near future and mostly smart institutions have been doing this. But now we're at a point where we could see a break above your line of death, which is the green line, and start pushing up against that upper end of that Bollinger Band and start heading towards, I believe the yellow line is the 20. Is that right?
Yeah.
Yeah. So this is a daily, right?
I just went back to the daily and see, where we were.
Yeah.
I'll go back to the weekly. Sorry about that.
No, you're fine. But this is one of those, in my opinion, this is when you start to look out further than just, 20 seconds ago, and you start to see what is really, where is the money starting to be distributed to. And in my opinion, it's for a while now, it's been back and forth into this bond market side of things. And we're talking not high yield bonds, which are high risk. We're talking more investment grade bonds, which is, triple B and above, and up to triple A bonds. So even like take a look at the aggregate bond index, AGG, I think it is, or AAG.
Yeah. I was just going to mention, you can see back here in the pandemic era, this is what happened to the TLT when the market dumped. Yeah. Look what happened.
Insane. Yeah. I mean, you can go back to what, 08, 07, 08. You saw it as well.
Here's 08 right here.
Yeah. Yeah. It's not, I bonds for a lot of my career were not that well performing until you went through big blowups like the .com or the housing, the great financial crisis, and then the pandemic. But now it's like it's getting really interesting, and it could be a sexy asset class for at least a little while over the near future. Something to consider for sure. Yeah. But yeah. So one of the other things I wanted to hit upon was a relationship of asset classes, and one of them is gold versus copper. And why this is significant is because they each represent a type of risk on or risk off. And risk on is copper, and copper is used to build homes, to build semiconductors, to build infrastructure, all that. We use that. So when copper is rising in price, you see a bullish environment. When gold is more of a defensive place, that's where people run to because it's limited amount out there, it's scarce, and people run to it historically as a defensive place to go, like they would be doing, and as they're doing right now, into U.S. Treasury bonds and high-grade investment bonds. So I wanted to show this chart to you. It's a ratio chart, so it's a comparison chart, and it's a pretty accurate indicator that something to pay attention to. And so tell me when you can see this one.
Yes, sir. Yep.
Okay, so this is, the ratio is gold versus copper. So gold rises. In this case, gold is more in favor. So we saw that from April of 19 up until August of 19, came back down, and then we saw gold become stronger and more of the asset that people want to be in versus copper. So more of a risk off side of things. We got to the pandemic here in February of 2020, and of course you can see gold became very popular as we started going through the pandemic, and then it started rolling off in April, May, and as you can see, it declined because markets got more riskier. Mailbox checks started coming in, and we saw growth in the housing market. We saw people buying new homes, refinancing homes. Big tech moved the whole bit into 21. It sort of petered out a little bit through 22. We then had in May of 22 another pop into gold out of copper and back down into 23, February of 23. And then we have slowly just been trickling into gold from 23 until I would just say, let's just go to here, first of last month, July. And then all of a sudden we've had a major move, vertical move from into gold and out of copper. And we're now back to where we were in August of 19. Now, there were some internal financial money flow issues with the reverse repo market, and that is the exchanging overnight market of banks and borrowing institutions exchange, say, treasuries for dollars for overnight settlement, that kind of thing. I'm not going to get into that because it gets real complicated, and I've been told I can bore people to death with it. But if you're interested, check it out. I'm writing an article on what happened here. So check us out at Best of US's articles. It's free. But the concern that I have here, Mark, is that we start this continuation rotation into gold and out of copper. And this historically has been a very good indicator of that risk on, risk off trade. And if we see, in my opinion, a break right around 633 or so on this ratio, we could be seeing another pandemic scenario. Let's see if I can go out to the .com boom or bust. You can see this from 2007. We saw an incredible spike starting in September of 2008. It peaked out in February of 2009. And then, of course, copper became stronger, more of a risk-on asset. Money flowed there. And you can see just the rotations that we're seeing. And it's a very accurate ratio. And so it's something I think people, it's not you look at it every day kind of thing, but to keep in mind, we're seeing more money rotating out of the risk trade into the risk off trade. And this is a very good picture of what we're potentially facing here in the near future.
I think that, there's just a lot of tools and out there and reports and just look around your life and see how people are living and go to a restaurant, see if it's just full or if you had to wait, to get in anymore, and just make up your own mind of what you're seeing and, take this news with a grain of salt and look into it a little deeper because, there's a lot more information there after the headline news, and a lot of this market gets traded on headline news instead of, that's why you see markets go up. And then at the end of the day, you're like, what the heck happened? It just fell. Well, people start reading into what's really happening and what's really happening. It looks like is a slowdown right now. And I think the Fed's worried about unemployment rate rising up because they made mention of it yesterday in the FOMC, and they don't really mention that too much over the last 18 months. So just be careful, and that's why we trade the way we do, and we use charts to help us become more, have a higher probability of success. Nothing's 100%. Okay, we have loser trades too, but we have risk management that prevents those trades from getting out of control so that you're not 10, 20, 30% down on a particular position, because that's no way to live your life every night going home, going to bed and saying, I used to have $1,000 and now, in my account, now I only have 600,
right.
or even more or less, and it's just not what you want to do.
No, and I think, most of the people who are probably watching this have been through probably at least one of the major blowups, if not a lot of them. And the key is how long does it take you to get back to even? And unfortunately, these markets can outlast you more than you can outlast these markets. So it's really important to protect your assets. And if you have profits, I was talking to my old business partner yesterday, and we were talking about NVIDIA. One of her clients has 4,000 shares of NVIDIA, and he bought in his cost basis equals out to about $30. And he's like, I don't want to sell it because of the tax ramifications of it. And I'm like, pay the tax. You don't want to go back down to 30.
So it's his philosophy. I want to sell it at a loss so I can write it off. Is that better?
I don't. I didn't get into it because it's none of my business. But I just was like,
when you're paying taxes, you're probably doing something right.
yeah, it's like if you made that kind of money on that,
Or
you know what?
trade it in your IRA instead of a cash account.
Right. Or just look at it as a contribution or rent payment to live in this country, you
Yeah, there you
know? But yeah, and I think a lot of people are facing that right now is that, oh, it'll go back up. It'll go back up. If you have doubt, there is no doubt. You know the answer. So be careful. I think we're going to continue to see this roller coaster throughout the week, if not going into the rest of the month. And protect your assets. Use risk management tools.
We have two more big tech announcements after the belt today, so
Yeah,
we'll see what happens.
we will. So if you enjoyed this and you'd like to learn more about what we're doing, you can give us a try. We have a 14-day free trial for the Best of US Investors. You get a whole lot. You get us talking about the macro, talking about markets. You also get Carrie's cheat sheet. Mark produces a swing trading watch list along with education behind that and how to use it and how to work it to build a process to investing. We've also got ETF tracker where we track 412 different ETFs based on Mark's principles of moving averages and more of on an intermediate term perspective. And I think the biggest powerful thing about our program is the Discord. And we recently introduced about 2 weeks ago the Discord Live. And that's where tribe members can get on and they can talk back and forth. I know I'm on it at least once a day. Mark's on it, I think, twice a day or so. Carrie's on it once a day at least. And it's back and forth. And a lot of tribe members have become very active in this. And I'm actually starting to see more of some of the tribe members talking about educational items, like how to read charts and that kind of thing. It's not advice or recommendation, but what we're seeing is this community growing. And I think as we enter the next 12 months, community is going to be your biggest, most powerful tool when it comes to navigating these markets and the economy ahead. What do you think, Mark?
Yeah, I think so. I think you work all your life to save this money and go into retirement, and too many times people get caught up into a situation where you're ready to retire, you're ready to buy something, and then boom, the market goes down, and like, okay, I'll wait, and then it takes too long to get back, and before you know it, you're taking up a part-time job or looking, to supplement your income until your retirement savings comes back. And I've been through several of these, and I know you have, and it's just something I don't want to do again. So
Yeah, and honestly, I think the other day we recorded a video and I was just ramped up. As in the core of it was concern for our tribe members and concern for those people I used to work with. Because we've seen this movie before. We've all sat through this once before. And guess what? The ending's never different. It's never different, unfortunately.
Yeah, and history does seem to repeat itself, and you can see the signs. And everyone's like, "Well, you've been talking about this for a while. When's it going to happen?" Well, you just never know.
You don't.
But it's not like we're sitting out. We are swing trading, and we are making money on the swing trade side. We just don't sit in that long. Okay,
Yeah.
From the swing trading side. Now, Carrie's side's a little different.
It is, and I think that's the great thing about what we have here is three different perspectives on markets. Your time frame and my time frame and Carrie's time frame are all three different time frames. And I think it gives a little insight to, Kerry's time frame is 100 years. He's going to be 80 years old in September.
Yeah.
He's looking at this as an evolution, a change, as someone would have in 89 to, to 2000, to today. So it's a different perspective. And I think that's the great thing what we offer here. So, Mark, you got anything else you want to hit on?
No, I think we've ranted enough today. So for two regular guys, we should go out and cut the grass or do whatever two regular guys do, and that's what I'm
right.
planning on doing.
Right on. Well, thank
Yep.
you for joining us, and Mark, it's always a pleasure to be doing this with you. Always
Yep,
brings
fun.
up great things. So hit the subscribe button, hit the like button, go check us out at bestofusinvestors.com or www.bus13.ai. That's www.bus13.ai. Sign up for our 14-day free trial. Check us out, learn more about us. In the meantime, be safe, risk manage, and preserve your family's wealth and live loud. Peace.
Cut.